What's up, everybody? This video is a follow-up to the video I posted at the end of last week titled, I'm buying this sector now at 3 times free cash flow. I'm going to put a link to that in the description. I encourage you to check it out. In that video, I explain why I think certain small upstream oil producers are just dirt cheap right now. I think that there are several really compelling deep value opportunities here. And the previous video was more an overview of my thesis, a look at the oil markets. I talked about how I think about valuing these types of companies. And in this video, we're going to get more into talking about specific names. Before we get started, I want to remind everyone, none of this is advice to buy any of these companies. When you find a company that is trading for 3 or 4 times free cash flow, there usually is a reason. The companies we're going to look at today are, in general, not really high quality businesses. They have problems. They might have high debt. They might be in regions of the world that have geopolitical risk. There are reasons these companies are dirt cheap. So again, not advice to buy. I'm just giving you my opinion and telling you what I'm doing. I do have a portion of my portfolio invested in a basket of these small companies. Even if my overall thesis on the sector is correct, I very likely will be wrong about some of these specific companies. Now, with all that said, let's get into it. If you get value out of the video, subscribe to the channel. I am working on starting a Patreon, so for everyone who's asked about my sheets and my watch list, it will be up there, hopefully within a month. I'll let you know here on the channel when I start that. Now, let's dive into these specific oil and gas producers. I was going to start with Vital Energy, which was the company that I use as an example in my previous video. When I was making that video, Vital Energy was trading for $14 and change. Today, less than a week later, it is up 20%, and it has been announced that Crescent Energy is looking to acquire Vital. Obviously, and this should go without saying, this is pure luck on my part. I have no ability to predict short-term moves in stocks. When I talk about a stock on this channel, if it's up or down over the next month, that is more a factor of luck than anything else. I was looking at Vital because I think that they're just grossly undervalued. They are absurdly cheap. Their main problem is their debt, which is quite high, but they are trading for less than 3 times where I think their normalized free cash flow is. And I suppose Crescent Energy agrees. They're maybe looking at similar metrics that I am. And while I'm very happy to be up over 20% on this position in a week, I actually wish Vital didn't look to be acquired because I think over the next few years, this company would have been a multi-bagger. So getting back to other businesses, let's look at Berry Corporation. This company currently has a market cap of about $230–240 million. Taking into account all their debt, they have an enterprise value of $640 million. So, net debt, roughly $400 million here. Their proved PV10, this is a very common metric that you're going to see in oil producers. PV10 stands for the present value of their current proved reserves if you discounted that at 10% a year, a 10% discount rate. So when you see PV10, this is some measure of the value of their reserves, the oil that they have not pulled out of the ground yet. In this case, these are proved reserves. And for them, this value, $2.3 billion. This is nearly 4 times their enterprise value. While it's not uncommon for proved PV10 to be greater than enterprise value, you rarely see a discrepancy this big. Now, one of the potential flaws of this company may be a reason why the market is selling them off so much. Their production is really primarily in California. When we think of oil producers with geopolitical risk, we might be thinking of, a producer in Colombia, or maybe a producer with an offshore oil project in Africa. But I have to say, having oil production in California, I would consider a geopolitical risk. California is not the most friendly to energy companies, and Berry says they have all the permits they need, they're in a great position. But this is something to keep in mind. As far as the mix of oil and gas in California, in the San Joaquin Basin, this is pure oil. This is 100% oil. In Utah, where the rest of their production is, it's 65% oil. The rest is natural gas liquids. They are potentially looking to grow in Utah, but keep in mind, this is a small piece of their total production. The bulk of their business really is California. And these oil wells they have in California, they have pretty low decline rates. What that means is when you drill a well, you get the most oil in that first year. This is actually a pretty good visual. Focus on the light blue line really quick. For a conventional well, basically drill a hole in the ground, oil comes up. These are the type of wells that Berry is drilling in California. The decline from year 1 to year 2 might be, 10%. From year 2 to year 3, yeah, you're down another 10% on that. And the well can keep producing a decent decent amount of oil for quite some time. In contrast, look at the dark blue. So they label this as a tight oil well. Think these are the wells that are being drilled a lot in Texas, anywhere where you hear shale oil. If a company is trying to get oil out of a shale rock formation, that is tight oil. And those wells, they have massive decline rates. So yes, you could get an enormous amount of oil in that first year, but the drop off from year 1 to year 2 could be 40% or even more. What that means for the business, for the company, is if you want to maintain your oil production, if you want to keep your oil production steady year over year, if you have conventional wells, you don't have to reinvest as much into CapEx to maintain that production. On the other hand, if you are a shale oil producer, you have to have a large amount of CapEx just to keep your production flat year over year. So Berry has nice low decline wells, ridiculously cheap relative to their reserves. They are currently trading for a bit less than 4 times their last 12 months free cash flow. They are looking to reduce debt this year. A lot of free cash flow is going there. I like to see that. Some cash coming back to shareholders in the form of a dividend. They have a whole slide in their deck on regulation in California. I think this is what turns some investors off of this company, but they're saying they actually see some positive news here. There was an ordinance that was adopted on June 26 that would enable certain drilling permits to be given out. A superior court would have to approve this, and that ruling is expected in the 4th quarter of this year. So we'll see what happens. I wouldn't necessarily say my hopes are high on this, but the important thing is this. Berry has the permits in hand today to execute its California drilling program through 2027. And again, once they drill a well, the decline rates are relatively low. They keep producing for many, many years. California decline rates, they say, 11 to 14%. Now, while California has not been the most friendly to energy companies, that is in some ways an advantage to Berry. There are no pipelines that run to California. Pretty much the only way to get oil into here is you have a tanker that comes up along the coast and just drops the oil off. That is how California is getting, about 80% of their oil. So there's a strong demand for Berry's output here, and there will be for a very long time. Their debt is okay. Again, they have about $400 million in net debt here. It's coming due in 2027, so in 2 years. But they do have the option to extend it twice for 1 year each. They would have to pay a little fee to do this. But the end result is they wouldn't have any significant maturities coming due until 2029. So debt is not amazing in my opinion, but it's acceptable. Looking at valuation, this is why I'm excited about Berry. They are just dirt cheap, over 20% free cash flow yield, basically generating over $60 million of free cash flow on a market cap of not even 240. Enterprise value to EBITDA, also ridiculously cheap. And the thing is, I think the company can maintain these numbers. Obviously, if the price goes up, free cash flow yield will come down, but that would be a good problem to have. They have a significant amount of reserves, and they're just going to be a cash flow machine. A real risk, of course, and this goes for every company we're talking about, is, low oil prices. Again, if you haven't seen my previous video outlining my thesis on the oil market, go check it out. I'm not arguing that oil prices are going to go to the moon. I just think that we're going to have normal cycles. There's going to be periods of high prices, periods of low prices. Right now, we're a bit towards the lower price side of that cycle, and Berry is still making a ridiculous amount of money. Yes, if oil prices go very low and stay there for a very long period of time, that would be extremely bad for pretty much all of the companies I'm going to talk about today. Pretty much all of them will be bad investments in that case. So yes, that is a risk. But to manage some of the risk of oil prices over the medium term, Berry, like many companies, they have a hedging program. Essentially, what they are doing is they are fixing the price that they can sell their future production at. So effectively, for the second half of this year, they've already sold more than 2/3 of their oil production, and they sold it at a price of, low 70s, $70 to $75. For next year, 2026, they have already sold more than half of their production, and they've sold it for a price of the high 60s, close to $70 a barrel. So overall, I think Berry looks excellent. Now, for most companies, as you know, on this channel, I typically have a sheet and I analyze, where I think their future is going to be in a bear, base, bull case. I try to model out revenue growth and operating margins and their multiple. But the fact of the matter is, for these small oil producers, it's almost a pointless exercise. The revenue and margins are going to be extremely dependent on where oil prices end up, and I can't predict that. At the end of the day, I don't think a spreadsheet is what's needed to understand the numbers on these investments. This company is trading for under 4 times free cash flow. Their reserves are good, and I actually think this could be a low price of the oil cycle. If oil prices move up, their free cash flow yield at today's market cap would be significantly higher. So if I think they can maintain a free cash flow yield of 25%, then, that's roughly what I'm expecting for a return on this investment today. Now let's move on to the next company we're going to talk about. And if you like the video, give the video a like. I don't think I've ever asked people to do that in a video before. I'm not sure if it helps liking a video on YouTube, but let's find out. Now, the next company I'm going to talk about today is Petrotal. And if you thought that the valuation for Berry Corporation looked good, the valuation of Petrotal, it's just silly. While the company is headquartered in Texas, the vast majority of their production is in Peru. So if you're buying into Petrotal, you have to take on geopolitical risk from Peru. Also, this stock is not traded on a major American exchange. So investors have to buy this on the Toronto Stock Exchange or maybe on the over-the-counter markets. For me and for some other investors, it's not really going to work to buy this over the counter. The amount that you might wish to purchase is just going to be too large a percentage of the daily average volume. So your purchase in it of itself is going to be moving the market price too much. There's more liquidity on the Toronto Stock Exchange, but I just think because this is not traded on the New York Stock Exchange, that in and of itself is possibly a reason why this thing is so cheap. Their oil production in terms of barrels of oil a day is pretty close to Berry's, and their market cap today is about $470 million US. So you might think, this is trading for $470 million US. The market cap of Berry is quite a bit less. It looks like Petrotal is more expensive, but here's the thing about this company. They have virtually no debt. This is really uncommon to see in a small producer like this. Long-term debt, $37 million. Cash on hand, about $100 million. They have a net cash position. This is an extremely well-run company. Their costs are very low, and because they also don't have interest on debt, their free cash flow is significantly higher than Berry's. They also pay out a dividend, which at current prices is an over 12% dividend yield, an absolutely crazy high number. For any other company, if you see an over 12% dividend yield, you have to think, what's wrong? Are they cutting the dividend? Do they have problems? In the case of Petrotal, it's actually quite the opposite. As I said, I think this is an extremely well-run organization. Here we see over the past 7 years, they've been growing oil production every single year. Meanwhile, they still have cash left over to pay out an incredible dividend to their investors, and they don't need to take on debt to do this. You don't find many companies you can say this about. The reserves of Petrotal have also been growing. They look pretty good. Again, the company is just dirt cheap compared to their reserve value. $1.7 billion 2P after-tax PV10. What this means is sometimes reserves are divided up into 1P, 2P, and 3P. 1P are the reserves that are proved. These barrels are there in the ground with greater than 90% probability. 2P is proved and probable. Probable is greater than 50% probability we can get these barrels out. 3P is proved, probable, and possible, which I basically just ignore because possible could really mean anything and I don't really put much weight in it. So $1.7 billion 2P after-tax PV10 means the 2P proved and probable, if you take the present value, discounting that at 10% a year, if you take that and you look at what that would be worth after tax, it's $1.7 billion US. Remember, this company is trading for $470 million US with virtually no debt. So just a silly valuation. And to not take on debt while growing production like this and paying out shareholders is, it's really incredible to see. In this slide that says investment thesis, they say Petrotal is Peru's largest crude oil producer and has demonstrated a commitment to operational and financial excellence since inception. Normally, when companies just puff themselves up and say, we're awesome, or we have operational and financial excellence since inception, normally I think they're overstating their case a bit. But with Petrotal, yeah, I agree. They've had operational and financial excellence since inception. Now, they are a bit less hedged than a company like Berry, so more exposed in the near term to the downside of low oil prices. Still, I think the company is extremely undervalued. The stock has gone up a bit over the past 7 years that this management team has been in place, but nowhere close to what I think is justified by the underlying operations of the business. Now, just to be aware, if you're looking at the price history of this company, the whole thing was restructured at the end of 2017, so you can't go farther back and see, oh my God, what in the world is going on here in the early 2000s? The company as it exists today, the management team, the Peruvian assets, basically everything started 2017 here. So let's talk about the risks here, because the operations are in Peru. There definitely has been social unrest in Peru before. That's a risk. There aren't pipelines to all their oil fields, so how do you get the oil out? If oil is produced over here, great, it can get to the coast via the North Peruvian pipeline, but what about if oil is produced here in Block 95? This is where they have their most productive fields, and it's basically in the Amazon. So what do you have to do? See this river right here, this blue little squiggly line? They have to ship oil down the river, it makes it to this port, and then, yeah, you can get it to the coast. Well, in the past, due to social unrest, there have been blockades of this river, and when this river is blockaded, they can't get their barrels of oil to the coast to sell. There's also political instability. Some governments in South America have flirted with the idea of nationalizing resources. So obviously that's a concern for investors. Overall, for me, in my opinion, operationally, the company is excellent, valuation is dirt cheap, and I think as just one piece in a basket of a bunch of small producers, I think Petrotal is a fit for me. That brings me to the third company we're going to talk about, which is Bayex. Now, if any of you follow the oil and gas space, you're probably rolling your eyes right now and saying, Bayex, really? You own Bayex? This is one of those companies you just don't want to admit that you own. It's just been going down, down, down the past few years, but I just think this company has gotten way too cheap. Anything under $2 a share for Bayex, in my opinion, it's just too low in spite of the company's problems, and they definitely have them. This is a Canadian company. They used to have most of their production in Alberta, in the Duvernay, and the Peavine, these areas right in here. Then a couple years ago, they bought up Ranger Oil. They bought up these assets down here in the Eagle Ford in Texas. This is shale oil, so those really high decline rate wells. At the time, they bought up these assets for the equivalent of about $2.5 billion. Some of that was stock, some of it was cash. They also took on their debt, but basically $2.5 billion, that is what the value of these Eagle Ford assets were at the time 2 years ago. Right now, Bayex, even though their stock price has gone up a little bit, it's not under $2 anymore, but the whole company is trading for just a little over $3 billion in terms of enterprise value. Market cap about $1.6 billion, but once you take into all their debt that they have, a little over $3 billion. The entire company today is barely trading for more than just these Texas assets that they bought a couple years ago. Keep in mind, the assets they have in Alberta, these are incredible assets. They have some really great wells here. These are very low decline rate, very long life of these wells. And just so you know, the dollar amounts here look different because these are in Canadian dollars. So market cap, enterprise value here, these are Canadian dollars. They're producing about 150,000 barrels of oil a day. So this is a significantly larger company operationally than Berry or Petrotal, close to 7 times the production. But in terms of enterprise value, the enterprise value is only about 5 times that of Berry's, about 7 times that of Petrotal. Bayex looking pretty cheap. You know, enterprise value to production to barrels of flowing oil is one way to look at these companies. You never want to put too much weight in any single metric. A single metric, whether it's price to free cash flow, price to book, enterprise value to barrel of flowing oil, every metric is just one piece of the picture, one piece of the story of the company. But a company that's trading for, just about $20,000 enterprise value per barrel of flowing oil, that's a pretty cheap valuation. Right now, they say they're prioritizing free cash flow, prioritizing balance sheet. That's a bit of a different story than the Bayex of a few years ago, which was kind of trying to go out and conquer the world. Because of that, I think Bayex management team does not have the best reputation. Probably deservedly so, but I think they're just too cheap right now. Between dividends and share repurchases, you're getting close to a 10% yield on this company. And even though they've diluted shareholders with their acquisitions, they've actually been increasing production per share. So they're basically saying, hey guys, on a per share basis, we haven't done too bad of a job. Their debt is rather significant, but because their earnings are just so high, the leverage doesn't look too bad. And they really have no debt to worry about in the near term. It's not until 2030 when they have a big repayment coming up. So they have plenty of time. Now, this slide is an important one. It's either really good news or really bad news, depending on which way you want to look at this. Bayex's free cash flow is extremely dependent on the price of oil. More so than any of the companies we've looked at so far. The price of oil goes from $60 to $70 a barrel. That almost doubles their free cash flow. This is because Bayex is not a low-cost producer. Again, it is not the highest quality company in town. If you just imagine that hypothetically your free cash flow break even for your company is $50 a barrel, then if the price of oil goes from $60 a barrel, where you're making $10 a barrel free cash flow, to $70 a barrel of oil, that's now $20 a barrel of oil in free cash flow. Your profits double when you go from 60 to 70. I bet you can probably imagine what would happen to Baytex's free cash flow if we enter a cycle with high prices of oil. If oil went to $80 or $90 a barrel, Baytex would fly. Make no doubt about it, Baytex, I think, is a levered, asymmetric bet on the price of oil. Baytex isn't really making money at $50 a barrel. If the price of oil goes below that and stays below that for a very long period of time, yes, Baytex is in trouble. That is the risk you're taking here. But I think if you can get Baytex at a great entry price, in my opinion, I think anything under $2 a share is probably a decent entry, then I think Baytex is just an asymmetric bet. The upside potential here is very large. They have a slide on their 5-year outlook. They think that they're going to continue to increase production, and they think they're going to get free cash flow per share up to $1.15. Now, I will say, again, their free cash flow per share, this is going to be heavily dependent on the price for oil. If you look in the fine print, they're assuming oil at $75 a barrel for these metrics. And $1.15 at today's prices would be, close to a 40% free cash flow yield. Their numbers are in Canadian dollars, so I'm referencing the listing on the Toronto Stock Exchange here. For clarity, when I talk about under $2 a share, I was talking about the listing on the New York Stock Exchange. Baytex trades on both. Even right now, at oil prices today, this company is delivering over 20% free cash flow yield. So overall, it's just really cheap. Their reserves are okay, about 650 million barrels of 2P reserves. Given the price of Baytex, it's really not bad. And I think, honestly, that's my general thesis on Baytex is, given the price of Baytex, it's really pretty good. It's a hate-it company. Some of that is deserved. Again, not a low-cost operator. They have more leverage to oil prices than other companies. That is a risk, but I just think they are too cheap. And I think to avoid this video getting too long, we'll wrap it up here. We looked at Berry, Petrotal, and an honorable mention to Vital Energy. Again, while I'm happy to be up 20% on this, I'm kind of surprised that management decided to sell the company for such a cheap price. I think it's worth much more. I would rather have held on and make an excellent return over several years than a quick buck in a few months. But regardless, I hope you got value out of the video. If you did, subscribe to the channel. Let me know what companies you're looking at. Let me know your thoughts on these companies. Do you agree? Do you disagree with anything I said? Let me know down in the comments, and I hope to see you all in another video.